Hi, my name is Jeff Fowler. I'm the president of the Apartment Owners Association of California. It is great to have you with us here today. We're going to be talking about reinvestment options for 1031 exchanges. And before we get started, I want to give a massive thank you to all of you that responded to the email that we sent out a couple weeks ago. If you're in the LA city area, we sent emails out. We called to the city, LA Housing Committee, and we just shared with them. We gave them feedback about why CPI is not the right metric to use when they're trying to control how much rent how much of a rent increase we can give. They've tabled that discussion. They're in review now, so we have less than 60 days to communicate to them how housing really works. They don't own rental property. We do, so we have to share with them. These are how the prices work. It's not CPI. It's not how much a taco costs. It's how much property insurance is, and how much utilities are, and how much fixing a disposal is. And so these are the things you need to give them your feedback. You need to call them if you're in the city of LA. And we're here to fight for everyone. Down in San Diego, we sent out a thing. It didn't turn out as well, but we're fighting the fight of our life. And if you think about it today, folks, we're controlled when we can evict. We're controlled how much we can ask for rent. We're controlled when we can ask for it. We're completely controlled at this point. This is socialized housing. We have to fight against this. We have to stand up. You have to let your voice be heard. And even just giving them feedback on what it costs, that's not fighting against the socialization of housing. That's just a bare minimum that you can do. And so let people know how regular economics 101 works and what the best way is. And anyway, so thank you for fighting with us, doing that together. And so yeah, this live stream is brought to you by H&S Wealth. They've been advertising with AOA. They've been doing seminars and in our trade shows for over 20 years. And they're just a great company. We have great feedback from our members about their services. So it's really a pleasure to have them sponsor this live stream today. Just want you to know that we have other live streams coming up. Last week, we had such an awesome one. It was about how to organize all of your stuff that relates to each property that you have. And it was awesome. And it ended up being one of these things that's like, wow, this is how I can leave a legacy. I can organize all of my stuff, have it put together, and then if anything ever happened to me, my kids or my wife or whoever could pick up right where I left off and know exactly everything that's happened with this tenant, with the property. And anyway, so that was a great one. If you missed it, you missed it, because we took that one off, and that's only available for AOA members within their member portal now. But most of them we leave up, so you will want to subscribe. And on the 27th, we're going to have one that's how to prepare for a small claims court. And so you'll want to get that. And then we have a Master the Move-In process coming in June. So again, you'll want to catch these and learn from the pros what they're doing, and see if, I guarantee you there will be an idea that you get that will help you save or keep more money than ever before. That's what AOA is all about. We want to help you. We want to give you those ideas so that you can save or make more than ever before, and make the process of providing housing easier and more enjoyable. So that's what we're all here for. So we're going to get into it today. 1031 exchange is a great way to do it. And so I'm going to introduce our first speaker today. She was a transaction coordinator since 2010, so she's very good with details. She's a broker at this point, a real estate agent, and they've done projects anywhere from single-family homes all the way up to 100-plus unit buildings. So very experienced, and our whole staff here with the AOA Brokerage, very experienced. And anyway, so it's my pleasure to introduce to you today Sara Ianni.
Hi, everybody. It's good to be here today. Very, very honored and excited to be here. Thank you very much, Jeff, for that introduction. So, like he said, my name is Sara Ianni. I am a real estate agent here with AOA Commercial Brokerage. And AOA Commercial Brokerage is a department in the Apartment Owners Association. We are a full service department of the association as a real estate agent. We are For the past 40 years, AOA Commercial Brokerage has been servicing apartment owners. We are located here in Van Nuys, so if for any reason you need to deal with a real estate firm that you can trust, go ahead and call AOA. We're in the main office, like I said. Our contact information should be displayed throughout this seminar, so go ahead and just jot that down, keep it in your notes. So you've been working with AOA for a while. Maybe you've done credit checks, you've needed a vendor, you've needed advice. If you need any real estate advice at all, go ahead and just call AOA, ask for the department, and then they'll go ahead and transfer you over. So first, I just wanted to repeat, in case anybody logged on late, if you guys have any questions at all throughout this seminar, go ahead and feel free to type them in the chat from whichever platform that you're viewing this on. So if you're viewing this from YouTube or Facebook, it's just going to be in the little chat box. If you're watching this directly from the AOA live stream on our website, there's a blue help button. Go ahead and click that, and then I believe there's another thing you're going to click to say interact with or something like that, and then go ahead and just type in your questions there. We do have a Q&A session after for that. So, as you know, talking about the real estate cycle, as you know, the cycle, my research, values in real estate go in a cycle. My research has found that the average full cycle spans about 18 to 19 years, which indicates that that's usually about 8 to 9 years up, about 8 to 9 years down. Now, currently, we are in what they call a bull market. A bull market is a sustained period of time where the prices keep rising. As you guys know, the price, we've passed the 8, 9, even 10 years of a seller's upcycle, and the prices do not seem to be dropping yet. Another indicator that we're still in a seller's market is how long the properties are staying on the market. And on an average, the properties are not staying on the market very long. So I got a graph from my local MLS. This is on residential income apartments in the Los Angeles County. It's from the past 5 years. So as you can see that prior to last year, when everything was shut down, the properties were not staying on the market very long. They were only on the market for an average of 25 to 30 days. Last year, that number did go up, understandably, to 44 days. And now, as the county is starting to reopen, we're starting to see some more activity. That number did drop. Now we're back at 31 days. So we're still early on in the year, barely in the second quarter, and I'm really curious to see what that number is going to be by December, because I think it's going to keep dropping. That's my opinion. So like I mentioned earlier, the prices don't seem to be dropping yet. Now, there are some exceptions. Buyers and investors are not just going to buy any property if the numbers don't make sense. But if the property is priced right, it's easy to show, along with some other variables, then as a seller, you're definitely going to see multiple offers, possibly all cash, very attractive terms. And to properly determine the value of your asset, at this point in the cycle, there are so many variables. I would say that each apartment building probably has its own unique value. So for that, I can't just look at websites that show what the neighbor sold for. I can't just look at comps and decide what your building is for, although I do look at comps. They are very important. I incorporate them in every evaluation that I do. But to properly determine the value of your asset specifically, it would be essential to have a little conversation prior to getting you that evaluation. So whatever it is that you're planning to do with your building, if you're, thinking about utilizing a 1031 tax exchange into a more profitable like-kind property, you may be ready to exit out of this portion of the industry. And by this portion, I mean the day-to-day activity that goes with managing rental real estate. But you are understandably concerned on how to maintain your income stream or possibly generate even more income. So those are, understandable concerns. So whatever it is that you're planning to do, the first step is to get a free property evaluation, call AOA, ask for Sara in the brokerage department, and we can definitely get that started. So we also have a form. You might not want to have to call. You can see it. I have you may have seen it around. This is our property evaluation. It just has a couple questions of some things that I might ask, the address, a little bit of the income and expenses, some of the main conditions of the property. So we have that form. It's in the magazine, both digital and physical copy of the magazine. It also gets sent out in the membership packets, I believe. So for that, you can either just fill that out, scan it, email it, fax it in. You can even email it the old-fashioned way. Now, if you don't want to deal with paper, we also have a process that you could do. It's online. So you would just go to our website. It's aoausa.com. You're going to click on the brokerage tab, and then you're going to scroll down a little bit, and then it's going to say click for property evaluation. Go ahead and click that, and then you fill in some information, submit, and then it'll be on its way. And then also you can just call me, or you could call me to let me know that you filled it out so that I know to look out for it. Either way, we can get this started for you if this is something that you're considering. Now, as we have mentioned many times here at AOA, the main goal is to help you make and or keep more money than before, and to do it more enjoyably, right? So if you are contemplating the possible sale of your rental real estate, you may be aware that you do face an enormous tax bite upon that sale, and that is bad news. But the good news is that capital gains taxes can be deferred and ultimately avoided if you do have the right strategies, plans, and information in place. And that is what we plan to share with you today. That is what Bryan with H&S Wealth Management has been doing for many, many, many years. And he is, fantastic. We have many, many clients who are just, very comfortable and satisfied with the service that he gives them. So I'll go ahead and let him introduce himself a little bit more. And that's it for my portion. Like I mentioned, if you guys are contemplating the possible sale, go ahead and give AOA a call and ask for the brokerage department, and we can definitely help you get that started. Thank you.
Thank you, Sara. That's a great introduction. As you heard, my name is Bryan. I'm with H&S Wealth Management, and I want to talk today about some changes that may or may not be coming to the 1031 tax rules and laws and tax rates. The good news is I have been doing this quite a long time, about 19 years. I've been involved in thousands of transactions. I've literally lost count, and either indirectly or directly, hundreds of millions of dollars of equity of investment into 1031 exchange replacement property. While we at H&S handle a variety of investment products, our focus, and mine in particular, is on 1031 exchange. It's a large portion of my work. So that's the good news. Hopefully I can share with you some things that are happening or potentially happening under this new administration that we have. The bad news is, candidly, nobody knows anything. And by that I mean nothing has happened yet as far as what's been proposed. We know a few things that we can talk about, but the truth is there is literally no bill pending yet in Congress that would change the tax laws for 1031. The last significant change in 1031 rules was in 2018, effective through the Tax and Jobs Act, and that meant that basically personal property, a business, equipment, could not be exchanged, only the real estate, which is what most of us, certainly the members, deal with anyway. The only other change was in 2002 when George W. Bush lowered the standard capital gains tax rate from 20% to 15%. Now it's only over certain amounts would you be taxed at the 20% capital gains rate. So other than that, things have been pretty standard, pretty much stayed the same. We know that with a new administration and with a new Congress, at least for the next 2 years, that there could be some substantial changes coming, and I want to talk about that. I just want to emphasize none of this is written in the cards. The first thing to think about is how could the Democrats and the Biden administration change things? Going back to the 70s, a rule was passed in Congress, was rarely used until the 90s, called budget reconciliation. You've probably heard that expression on the news. And what it means is normally any legislation requires a 60% vote in the Senate to pass, but that was holding up approval of federal budgets. And so a rule was made where only 51% would be required to pass in the Congress. And what that means is if you have 50 or more seats, you can make that decision to pass whatever you choose. And of course, as it stands, the Democrats in the Senate have 50 seats. The tiebreaker is the vice president, who's the president of the Senate. And of course, the vice president is going to vote along with the Democrats. So be aware that in the next 2 years, there will be 2 more opportunities to impose budget reconciliation. It can only be used once every fiscal year. The bailout for COVID that was passed recently was the first time it was used. There are 2 more opportunities while we know that the Democrats control the Congress. 2024, we don't know if it'll change hands. Traditionally, it has. Another unknown thing. But just to be aware of what's possible, if all Democrats align, not all of them do all the time, especially when it comes to 1031 matters, and if the president and vice president can keep the party in line, there are some things that could change, and they could change fairly dramatically. But what are those things? Well, we don't know, as I said at the top. What I can tell you is that there were proposals written and made during the campaign as to what the president would do if elected. And as we all know, most presidents make promises during a campaign that they're not often able to keep. So that's another thing to keep in mind. It's easy to make a proposal. It's much harder to implement it. What I've seen from the Biden administration has been very consistent. In other words, there have been almost no big divestitures from what he said he would do. So keep that in mind as well. There was one big change that I'll talk about in a moment, but let's go through a few things. There's been a theory about a wealth tax. Maybe rather than taxing income or dividend income or capital gain, we should consider taxing just someone's wealth. Well, that's, most economists would agree, very difficult and very unreasonable. I say that because, for example, your GameStop stock or your real estate right now may be at a top price, but in a week that could change. So what would you be paying the tax on? President Biden in the campaign and since elected has never suggested imposing such a tax. Again, doesn't mean it couldn't happen, but I can tell you he's been pretty adamant, and I think commonsensically, no one's going to get behind that. The top corporate tax rate was lowered in 2018 under the Tax and Jobs Act to 22%. That was from the prior almost 39% under the Obama administration. President Biden has proposed increasing it back up to 28%, so not as high as it was, but substantially higher. And again, if all the Democrats can agree to that, that can be imposed. The top individual income tax rate, the highest that anybody pays on income above $400,000 a year in your income, so not the dollars leading up to it, they're taxed at lower rates, but above $400,000. The top rate was 39.6% under Obama and under President Trump until 2018, when it was lowered to 37%. President Biden has now proposed returning it back to that 39.6, and most Democrats have agreed to that, at least in theory, in particular. Long-term capital gains and what's called qualified dividends from your stock or from your bonds or from other funds that you're invested in. He wants to not tax at a capital gains rate, which is really a high of 20%, typically 15%, but rather to the highest income rate, which again would be 39.6 if they're able to increase that, otherwise 37. So these are all things that have been proposed, and these are all things that have been consistent going back to the middle of last year on the campaign trail when they released a written tax plan. So what's new? Well, there has been something new. And as you see at the bottom bullet point, April 28th, just a few weeks ago, to my knowledge, Biden for the first time made a substantial change to what his proposals were previously with regard to taxes. Why did he do that? Of course, I can't tell you why, other than I do know that he is now in the seat of the president. It's one thing when you're running for office, it's another when you're actually looking at the bills. Also, I think there's a certain amount of negotiating that may have to take place with Democrats to get them all on board. As I said, he only needs all 50 of them to line up. What did he change? Well, previously and consistently, he has said anyone with income below $400,000 income, nothing's going to change. Your tax isn't going to go up. In fact, some people will drop. You'll be able to continue to 1031 exchange your capital gains and so forth. He changed that. Big change. What he proposed in the 1.8 trillion American Families Plan, is what it was released a few weeks ago and documented, is to abolish the ability to defer your capital gains on a 1031 exchange for anything above 500,000. So if you bought a property, I'm going to use simple numbers, for 100,000, held it for some period of time and sold it for 600,000, you have a $500,000 gain. Simple math. It's a little more complicated than that. Under this plan, you would still be able to 1031 exchange up to that $500,000 amount and defer your taxes. The rule would be that if you bought that same property for $100,000 and it appreciated up to $1 million over the time you held it, only $500,000 of that $900,000 could be exchanged. So that would leave $400,000 that you would have to pay taxes on. The taxes in simple math could be up to about a third typically of your net cash proceeds. So a pretty substantial sum. On $400,000, you're looking at $120,000 or greater, depending on your circumstance. That's a big change. Why did it happen? Again, I can't tell you why, other than I suspect he wants to pay for about 1.8 trillion in support and aid. That is not going to the deficit. It is a zero-sum proposal. That means all of these other, or many of these other tax increases are built into that to pay for it. The big change was on 1031, these chasing more capital gain that would normally be deferred. Again, having been in the industry so long, having been through really two major scares, if you will, of 1031 going away or changing dramatically. It's only happened about twice where it was going into negotiation and built into a bill. Always it's been defeated. Simply just doesn't make fiscal sense, is the bottom line. So my personal view is probably this won't even go through. Although I think there's two possibilities, and again, maybe there's a negotiation going on here. Number one, the amount could be increased to anything above $1 million. And number two, it could go back to that if your income was over $400,000 last year, regardless of the gain, you can no longer exchange. One thing that we almost know is that probably nothing's going to happen effective 2021. First of all, in the U.S. history of legislation, there's never been a retroactive tax. In other words, when Congress changes something and it imposes additional taxes, nobody's ever gone back and said, oh, last year you did X, Y, and Z, so now you're going to be taxed. They have done that when there's been a credit, something that benefits the taxpayer, but literally never has it happened on the downside. Simple way to put it, if that holds true, any exchange you do this year, and this year might be a good year to sell your real estate and do an exchange, it's highly unlikely that that exchange would be disallowed. We're crawling out of a recession, as we know. It's sort of inherently unfair, as we could all agree, since you didn't know what the tax consequences were when you took the action to sell. And while it's not constitutional, the Congress technically could do it. Literally, they never have. So that's kind of the state of the union, if you will, with regard to taxation and the 1031 exchange world. Let's talk about options now. What can I do when I sell? Well, one big disadvantage right now is all the advantages you heard Sara talk about. The market is hot. There is very little product, meaning apartment buildings and houses and rental properties and commercial that are on the market. There is a lot of cash, a lot of individuals that have the ability to buy, and there is very low interest rates, record low interest rates. They are creeping up, as you may have heard, but we're still well in that 4% to 3% range. And some people I've heard have still been able to lock in below 3% on a 15 or 30-year term. So it's a good time to be a seller. There is a lot of demand. Prices are reaching again a peak. And I'm comfortable that this is not a bubble like what we went through in the mid-2000s. Most of those properties that were purchased were with a tremendous amount of leverage, meaning the bank's money, fake money, if you will, Properties nowadays have 30 to 50% equity. People are putting down that amount. I'm not talking about homes where you could have 3 to 20%, but on investment property. That's a good thing. That means there's real equity into these properties. It's not likely that a bubble is going to burst and there's no value behind the property. These properties, if they had to sell, let's say someone couldn't pay the mortgage, it's very likely they would be able to pay off the loan and still have some proceeds to keep for themselves. So it's a good state for the real estate market as we sit. Now, that being said, if you own something, let's say in the San Fernando Valley or the South Bay of Los Angeles, you're going to list your property, and I'm going to tell you from my experience, it's going to go faster and it's going to go for more than you expected. I've just seen that consistently with many clients. It's a bold statement, but I've not yet been proven untrue. So I feel that if you work with Sara or any of the folks that you work with through the brokerage here or elsewhere, you're going to be able to list that property and there will be multiple offers. We're seeing that in residential homes for residents as well, but it's impacting the multifamily and the rental world. So the good news is you'll be able to sell pretty quickly, pretty smoothly, and probably for a very healthy return. The bad news is if you want to buy in Southern California, in the Valley or in the South Bay, well, now you're in the seat of the buyer, not the seller. So for a 1031 exchange, as we all know, hopefully, you need to defer your capital gains tax. The IRS wants you to reinvest your proceeds, any cash that the accommodator is holding, into a new property, and any debt that you've paid off needs to be matched, either with a new loan or you could replace it with cash. You only have 45 days to identify what you want to purchase. You can go out of state. You don't have to be in this crazy Los Angeles market. But now, two things. Number one, you're going to be a absentee landlord, and I know that's a challenge for a lot of investors that I deal with. And secondly, prices even in markets like Las Vegas, Arizona, the Inland Empire, where I see people in Southern California looking when they want to get out of LA, prices there are appreciated. They're lower than here, but really it's just about every market in America. I think 9 out of 10 metropolitan areas have seen increases in home values and rental values. So all that being said, what are your options? Most people think there's only a couple of options. I sell my property, I get that great profit Adam talked about, and I pay my tax. Well, the tax as it stands today, and as I said, will probably be consistent through 2021, it varies a little, but I'll give you the high-level numbers. You'll pay either 15 or 20% to the federal government in capital gains tax, depends on your overall income, 3.8% Medicare tax or Obamacare tax on that same gain, so now you're at 18.3 or 23.3. You will pay to the state of California. There really is no capital gains in California. You just pay on income. They don't have a separate rate. Most people are around 10%. You could be as high as 13.3 if your income were over $1 million in a given year. And again, if you're selling a property and that puts you over that edge. Congratulations, by the way, as those of you that are California residents, we are the highest tax state now in the nation, surpassing New York. And that's, there's a 20% recapture of depreciation that you claimed over the years. And when you add all that up, as I said before, typically over a third of what you're taking out would be taxed. $1 million, you would end up paying about $330,000 to $400,000 in taxes. Not a very great solution. I often remind folks, not only do you lose that income in the year that you sold when you pay it in taxes, but you lose the cash flow that $300,000 or $400,000 could have produced every year. And when you start doing the math, it's a tremendous amount. It makes fiscal sense to do an exchange for most people, as long as this isn't your last dollar, basically. It's a conversation that we have to have and look at people's portfolio. But generally, 1031 exchange makes a lot of sense. And it's good for the economy. It's good for the real estate market. It keeps people selling and buying, makes what they call velocity or liquidity in a sense. So again, I see that the 1031 just makes so much sense, and very little tax revenue would be generated if they eliminated it anyway. And that's why I'm hopeful that everything will be left alone, like I talked about earlier. So anyway, you've got two choices. I buy a property local and pay a crazy price, just like I sold it for a great price. I can go out of state or out of this market, or I can pay my tax. And that's what a lot of folks I talk to feel that the story ends there. There is another option. You're probably hearing more about it recently with the properties selling and people doing 1031 exchanges often this year, again, because they're afraid that things could change next year, and they could. And that is the Delaware Statutory Trust, or DST. A DST is it's a model for co-ownership. It's the way that individual 1031 exchange investors, through a real estate sponsor company or investment company, can have their wealth pooled to buy a $50 or $60 million asset, everyone owning their share of that large real property asset. Now, DSTs are sold as securities. That means you have to be a accredited investor. They are not sold through the real estate market. They're sold through what are known as financial advisors. They're also not allowed to be publicly promoted. That's why you may not have heard of DSTs. They're not widely promoted, certainly any individual DST. We're talking in general about it, but we need to have a conversation before we can look at specific investment offerings. That's required by the federal government, the SEC and FINRA, with good reason, I think. So what is it and how does it work? Well, let's take a look at a few of these properties. These are pretty typical examples of what we like at H&S Wealth Management, primarily, as you see, Class A multifamily. Class A being the high-end luxury apartments. It's a little different in other states than here in Southern California. It's very difficult and very expensive to build a true luxury apartment here, and generally you have to knock something down in order to do it. But in other growth markets, and of course the prices are very high. In other growth markets around the country, though, Orlando, Florida, Atlanta, Georgia, Austin, Texas, where people are moving and jobs are moving, they can build these standalone sort of luxury complexes and properties for multifamily apartments. I stress that because we saw at H&S through the Great Recession some real challenges, as you can imagine. Obviously retail, between the internet and the way groceries have changed, the way people buy their groceries. That's had a big impact on the retail world and investment real estate. But B and C class apartments, basically middle and lower income folks that rent those apartments, really got dramatically hit during the Great Recession, kind of from the bottom up, if you will. Everybody was hurt. But in the end, the folks that are at the lower end of the income scale got hurt first and worse. And interestingly, that same thing happened with COVID, which we aren't smart enough to have anticipated, but the exact same pattern happened. Folks that were on the lower end of the apartment rental scale, waiters, waitresses, bartenders, etc., had to stay home. And in fact, they got to not pay rent, which was terrible for the landlords. On the higher end, those folks tend to be young working professionals. They tend to have jobs where they can work remotely. So what we saw was a little impact in what we call the Class A luxury market, collections of rent that are normally 98, 99% for these huge institutional properties, maybe went down to 96, 97%, a little impact. I can tell you I've read that in the B and C class world of apartments, collection rates dropped from whatever they were before, probably in the mid to low 90s, down to 70%. That means that tenants were only 70% were paying the rent nationwide. And then on the commercial side, particularly retail, 60% was the rate last year. And of course, this is all changing daily and creeping upward, fortunately, as things are subsiding. But my point is that the Class A multifamily, through the Great Recession, through COVID, consistently outperforms other assets in investment real estate. And that's why we've focused our practice primarily on multifamily. You will see an occasional self-storage facility. In a lot of ways, self-storage mirrors multifamily. And triple net properties, assuming there's a good 15 years or more remaining on a lease term, it's in a good location and has a solid tenant, although who knows what a solid tenant is anymore. We may look at that as a possibility too. But primarily, again, you've made your money on rentals, apartments. We know that. People have to live somewhere. I don't think you can sleep on the internet. At least we haven't invented how to do that yet. And there's a real demand for apartments. In fact, millennials, as they call them, younger people born after 1980, are tending to want to rent, even high-income folks, and put off buying a house or not put all their wealth in a home. They want to stay mobile. They've seen what happened in the Great Recession to their parents, and they're aware of that if they put all their wealth into a home, like most families do traditionally, that could go away 25 to 50%. So there is a change, and it all supports, again, good Class A multifamily. So how does this work? A sponsor company, not H&S Wealth Management, we're advisors. We will help place you into a DST if you work with us and you're interested. But there are what we call sponsor firms, real estate investment companies all around the nation. They number about 40 right now. They can purchase any kind of investment real estate and create this DST. What is this DST? Well, it's literally a trust. Each DST has its own property or sometimes multiple properties, but they're created with each new offering. In other words, this is not a REIT, an R-E-I-T. This isn't a pool of properties. You're literally buying a piece of real estate or sometimes a small portfolio of real estate. They create this entity in the state of Delaware, not surprisingly. They acquire it with their own capital or lines of credit. They arrange for the financing, typically very conservative loan, 50% loan to value is very common. They sign any guarantees or any requirements of the lender. Most of these loans are backed by Freddie Mac. They're what we call agency loans through the federal government. And they then sell off their interests to individual, usually 1031 exchange investors through financial advisors like H&S Wealth Management. They're pulling their money out as they're conveying the interest to you. And what the IRS said back in 2004 was to do a 1031 exchange. Typically, you normally have to buy investment real estate. A DST interest is considered for all tax purposes investment real estate. It's the same thing. It's structured differently, but effectively it's the same as buying your own property. You own then what's called a beneficial membership interest in the DST. And your share, let's say in simple math, you put up 10% of the equity to buy this property along with other folks. You're not in partnership with the other folks, by the way. Everybody just owns their individual share. But let's say you put up 10% of the money. That would be a 10% pro rata or proportional interest. 10% of the distributable cash flow during the hold period would go to you. 10% of the expenses that you can claim and deductions that you can claim would go to you. 10% of the interest deduction. And of course, on the back end, when the property sells, 10% of the appreciation goes to you. So it's true co-ownership. This is by design. This is what the IRS insisted upon. So you may have seen other investments where you're diluted, where the sponsor keeps the tax benefits or a portion of the appreciation. Maybe they take 20% and distribute 80% to the investors via a partnership. That is not permitted in a DST. It is true co-ownership. The range of cash flow, it's a moving target as prices have risen. Even as interest rates have been at all-time lows, they are creeping up as well. And the amount of leverage the lenders want the sponsors to be taking, it's actually in some cases crept below 50%. I think it's kind of normalizing now at 50 to 60 at the most. But you end up with a return cash on cash of about anywhere from 4.5% to 6%, and even below 4% I've seen, or 4 to 4.5 is pretty typical. So on a 4.5% cash flow yielding property, if you invested $1 million, you would be receiving $45,000 a year in income, cash flow yield, distributed monthly, not quarterly like a dividend, but monthly. At the end of the year, that interest that you have would then generate a tremendous amount of tax savings. And you report it just like you do now on your Schedule E on your tax return, or if your tax provider does that for you. Again, very much like just owning your own real estate. Now, you can have quite a few investor members in a DST, 499 to be precise. Usually it's more like 80 to 100. And I mention this not because you're in partnership with any of these folks. You don't really even know who they are. They just also own their share of the same property. But the investment minimum can be very low since the sponsor has the ability to raise money from so many people. So if they buy a $100 million property, they put down $50 million in cash, they can have a very low minimum since they can go up to 500 members. Typically that's not what happens, but it's a good thing. And why is that? Because with a $100,000 minimum perhaps, you can buy 2 or 3 or 5 DSTs, depending on how much net equity you need to reinvest. That's a tremendous amount of diversity. It's an opportunity to mitigate your risk by owning maybe a large apartment building in Orlando, Florida, and another in Austin, Texas, and another in Georgia or North Carolina. So you're splitting up your risk. You have a smaller piece of a much larger property, but instead of just one, or maybe even like one single family property that you could buy with one tenant, you now have literally 1,000 tenants in your 3 or 4 properties that you own a small piece of. It's a great way to diversify. And the biggest point about the DST is that it is ultimately a passive investment. You know, the cliche in our world is getting away from the 3 T's, right? The toilets, tenants, termites, teenagers, I could add, having one myself. The good news is that the sponsor is responsible for the property. They act as the trustee of the trust. They're going to make the decisions, and they are professional management firms that they work with to maximize the revenue on property, to have real-time data on what rents in a given market are, to keep rolling units, as they say, in order to keep up market rates. Many of us have tenants that we know, we like, we love, sometimes, and we don't raise our rents very often. And we all kind of get that rude awakening when the tenant moves out and you release, when you find out what you can get for the unit. These companies run their properties, these DSTs, like a business, because it is a business, and they're going to maximize that return. The reason that's important is investment property is valuated based on the income it produces, and there's a multiple called a cap rate that's applied. So if you can maximize the net operating income, reduce expenses, effectively manage your property, generally you can get a pretty solid return and steady cash flow. That's the goal of these assets. They're not likely to appreciate dramatically in value, although they could, simply because they are high-end apartments. They are charging high amounts of rent, and I believe that's a good thing, as I said, because of the security it allows for. Big questions I get. What happens with your 1031 exchange in the future? Every property is different. It depends on the market, as you heard Sara talk about, but generally we're looking at a probable 6 to 8 year hold period. So these are not what I would call a short-term hold or a parking vehicle. You can anticipate the sponsor is going to maximize the return possible. The market is going to go up or down, but they're going to sell it at the right time for that individual asset to maximize the investor's return. And that usually is in a 6 to 8 year period. It could be sooner when you're buying at the bottom of the market, like they were in 2014, and some properties sold in 5 or 6 years. In the Great Recession, some properties went as long as 10 years, or even longer in some cases. But as a good rule of thumb, 7-year hold is what I tell people to expect. Can you sell your interest in a DST before the sponsor sells the whole property is a good question. The answer is yes. It is not a liquid asset. Any real estate, according to the federal government, including your properties, are illiquid. In other words, you can't go to a market on a given day and push a button and sell your property at the going rate. You can list it and try to get the best price. Well, the same is true of a DST interest. The big difference being there is no formal secondary market for people to buy DST interests. Generally, when we have new clients come to us, frankly, there are none available, so we're showing them the latest, newest DST offering that's out there. What would happen if you asked the sponsor to try to sell your interest and exit, or a portion of your interest? You don't have to sell it all. You have the option of pulling some cash out. They will send out a notice to your fellow DST owners in the same property. This is built into the offering memorandum, giving them the right of first offer. You don't have to sell to those individuals. You sell for whatever amount you want. You determine that price. It's your real estate. It's your DST interest. But there is a built-in market of owners, as I said, usually 80, sometimes 100, of the same property who've been experiencing the same, hopefully, positive cash flow you have, who may want to grow their interest in the property. They're all accredited investors. They're all generally savvy real estate investors. So you've got a great built-in market potentially to sell your DST interest. And I can tell you, if you do find that buyer and agree on a price, usually a co-investor, it's a very simple process. There's no title, escrow, loan assumption. I mentioned the loan earlier, but I neglected to mention when you own a DST interest that has a loan, while you get credit for that debt, whether it's for 1031 exchange purposes, depreciation of the real estate purposes, any other deduction of the interest payments, for example, you're not directly on the loan. The lender, in fact, does not know who you are. So you have that level of protection of liability or recourse that goes away in a DST, and yet you get the benefit of the debt. If you sold your interest in a DST to another investor, in some offerings, there would be an assumption of the loan by the buyer, and that can be a problem if the lender doesn't approve your buyer. Well, that doesn't apply in a DST. It's literally a process that can be done pretty quickly with, I think, one notarized document, and that's it. No title, escrow, etc. But we always tell folks, and we stress, there's no secondary market. There's no assurance you'll be able to sell your interest in the DST. And typically, you're going to be in this investment for 6 to 8 years, as I said, and you should expect that. I can candidly say during the bad times, it was harder to sell interests in DSTs or the other form of co-ownership, and the only buyers were, sort of bottom feeders that, in 2010 wanted to pay a rock bottom price. During the good times, since then, really 2013, 14 to today, folks have been able to sell their interest again, typically to another investor. But we ask you not to think of it as a parking vehicle. You'll probably be in it for the long haul, and that's not a bad thing. So who do we work with for these offerings? These sponsor companies, I mentioned about 40 that put these deals together. We're only working with about 5 or 6 of them at H&S Wealth Management. And why is that? We're very particular with who we put our clients' money with. Who are the folks that are buying these properties, underwriting them, managing them, and then ultimately selling them. We want properties to have a full cycle track record. They've done this process and then sold properties so that we can show you the returns, the success of their prior investments. We also want to focus again on multifamily and self-storage. So what that means is you're narrowing the list down to about 5 or 6 sponsor firms out there that offer these investments. We're really particular about it. A lot of single tenant, triple net commercial deals are sold in this space, but they typically have less than 13 years remaining on the leases, and we kind of consider that a much riskier investment. With real estate, you want to remember the 3 golden rules, right? What did we all learn? It was location. I always forget the third one, but that's a factor. Whether it's a DST or your own property you're buying in the South Bay, you want to be in a good, solid location. You don't want a property that's too old that requires a lot of deferred maintenance. And you want to be in an asset class that has a good chance of growing rents. And again, I would argue that's multifamily and self-storage. You also want to look to job growth and population growth. You want to buy real estate in places where people are moving. And you want to have high income for the tenants if you're doing multifamily. As I said, they get hurt last and least, I would argue. So that's basically what you already know, but I'm telling you what you know because this is a new form of ownership of investment real estate. At H&S Wealth Management, we have a team of folks that can help you with this process. You may be interested in seeing what a DST looks like. We can talk about what's available currently if you're in an exchange or you're considering one in the next few months. And we also are happy to talk to you if you're thinking about doing this maybe a year or 2 or more from now. Reach out to us and we'll see if we can work with you. Our goal is to help you realize your goals and dreams. And with that, I'm going to pass it over back to Jeff. Thank you.
Great. Thank you so much, Adam. And just every time you speak, it's just like the most calming and incredibly informative time. So just really thankful for you. Thanks again. And so this is a great time for you to go ahead, those of you that are viewing, to put your questions into the chat. If you're watching on AOAUSA.com, go ahead in the bottom right corner, there's a little blue help button. If you click on that, you can type your question in there and they'll feed that question to me. And so we'll go ahead and get started with George. Your DSTs, do they have any historical track record?
Yeah, they do. That, as I mentioned very end there, a great question. I like to work with firms that can show that full cycle track record, and that means they have to have been in business for at least 10 years or greater. One of the largest sponsors and one of the ones we work with called Inland, it's no secret who they are, they're just not typically known brand names, but Inland has been in business for 52 years this year. A company called Pasco down in Orange County that we like very much is 20 years plus, and so forth. There are many firms out of that 40 that have less than 10 years of experience, and I'm not saying that those aren't good firms or they're not buying good real estate. They simply can't demonstrate a proven results that they've done. The sponsors we work with have done this tens to hundreds of times in some cases previously. It doesn't guarantee results for you, but you're able to look at exactly what they've done. And I will add that their interest is in repeat business. They want to not only have you invest in their DST today, but they know that in 6 or 8 years, this property will come to be the right time to sell, and you'll be faced with another 1031 exchange option. What we've seen and what we've heard from the sponsors and our clients, excess of 85% of folks stay with the same sponsor because the sponsor will always have a replacement 1031 property waiting in the wings when they sell an older DST. You're not obligated to. You can go back and buy your own real estate, buy a DST from another sponsor, or cash out and pay tax. You have all the same options. But yes, track record is extremely important to us.
Great. All right, and we have Ming Chen. If my rental was purchased for $100,000, sold for $1 million, with the $500,000 limit for 1031 exchange, do I need to buy a rental for more than $600,000 to take advantage of the 1031 exchange for the $500,000?
So let me stress, this is a proposal that was made on April 28th. Before it is even considered by the Congress, it has to be tied into a bill. This bill has not even been written. This is just a statement that the president made, and it was the first and only change that I've seen dramatically to anything he's proposed. So I just want to stress, this is not something that will definitely happen. In my opinion, it probably won't even happen at all, or it'll have a big revision if it happens, but it could. So all that being said, to spell it out for you, if this happened, in your example, you've got about $500,000 in gain, right? So the IRS would say if you reinvest $1 million, which is the sale price of your property, your gain of $500 is going to be deferred, and you'll be fine doing a normal 1031 exchange, deferring all your taxes. Let's say you sold for $1.1 million in this same example and your basis was $500 again. Well, that would mean there's $100,000 of gain beyond the $500, and under this proposal, that $100,000 would be subject to the tax, which again is usually about a third. So that's the way it's been proposed.
All right. Okay. On YouTube, Lady AHG. Is this as advertised? Are changes coming to the 1031 exchange industry or another stream on DSTs, which are not a vehicle for wealth, I am comfortable with? As to me, it seems like gambling. What would your response be?
Seems like gambling. I'm not sure if gambling is doing a 1031 exchange and buying other real estate or if you're referring to the DST. There's no guarantees in life, but death and taxes, as they say, and I could say that's still true of any real estate, including a DST. If you're buying something that you feel is a good property, let's say locally, you know the area, you've been renting apartments in Los Angeles for many years, I think you're probably going to make a good choice if you know what you're doing. Is it gambling or risk? Well, any purchase is, but I would argue you should 1031 exchange and buy something that you've done your review on. If you chose to do a DST, while it's somebody different taking care of the property, and that's often the thing that people worry about, and I understand that, the best thing about a DST is also the worst thing, and that's that you don't control it. So if you want the midnight calls and the diapers in the toilet that have backed up and so forth, and the sheriff coming out to take care of getting rid of your tenant, I speak jokingly, but that's what the sweat equity, the work that you do to manage your properties and to generate that wealth. Many folks, typically older, not always, want to get away from that. They want to spend more time with the grandchildren or golfing. What the DST allows for is for you to do a valid 1031 exchange, codified by the IRS, not a risky tax play, and to buy into not just one property, maybe with 4 or 8 tenants, but 3 properties that each have 300 tenants in maybe 3 different states, maybe through 3 different sponsor firms. So you're mitigating your risk. I would argue that's pretty far cry from gambling. There is still risk, but if you lose 2 tenants in a duplex, you're 100% vacant, right? But if you have 900 tenants in 3 different properties, it is highly unlikely you're going to lose 450 tenants on a given day to have that same, or 900 tenants total, to have that same vacancy problem. So I think you mitigate the risk when you buy into something larger. And again, the best thing is you have professionals managing it for you, and you don't have to deal with that day to day.
Great. All right. On YouTube, Jim, how are the sponsors vetted, those sponsor companies that you talked about?
There's I like to say, a lot of eyeballs on these offerings. So the sponsor company has to register it's a private security. They then raise capital, typically, not always, through the independent broker-dealer community. That means that there's literally hundreds of firms around the country that do their own due diligence and document it on each sponsor, so that they're looking at often audited financials and the history of the principals. Then, if they approve it for sale, they release it to their reps, as we're called, or financial advisors, registered representatives. And we do our own due diligence on companies and sponsors. As you've heard from me, I'm very slow to work with a new sponsor simply because they don't have the track record. So I know these companies well, and my business partner Bob knows them even better than I, having been in the business so long. So there are a great deal of due diligence, and that's important. Although I would stress that even more important than the due diligence you want to do on the sponsor is the due diligence done on the real estate, on the property itself. And I want you to know that generally when there's leverage on these properties, these are agency-backed loans. That means the federal government gives the sponsor a list of who can give them an appraisal. We don't want your opinion, sponsor, of the value. We want to know from an independent third party what the value of the property is, because that's what they base their loan on. They want to have an environmental study done. I doubt many of you have ever done that on a smaller real estate asset, but on these large institutional assets, they do always a phase 1 or phase 2. There's a property condition report where literally third-party independent people, engineers, go and look at the property and figure out what improvements might be needed. Is it going to need a new roof in a few years, etc. And the list goes on. So there is a great deal of due diligence done both on the real estate and on the individual sponsor company. The best foreteller, I think, while not a guarantee of future results, is past performance. And again, that's why we work with seasoned, experienced sponsors.
Great. Thank you, Adam. All right. Next question. And that's just such a good question, I think. Okay, Robert, here we are. Are DSTs available for investors even when a 1031 exchange is not needed by the investor? If so, do you see some people investing in DSTs without the 1031 exchange?
Yeah, the investment minimum for non-exchangers is usually stated in the offering memorandum as low as $25,000. If it's a piece of real estate you know well or like, you get all the benefits of any other investor, even though you're just writing a check essentially. And most importantly, when the property sells in the future, that's 6 or 8 years down the line, you can exchange your investment. So that's a great positive to investing in DSTs. There are other investment vehicles we work with for non-1031 exchange investment that can perhaps get you into a fund of several thousand properties, without exaggeration, that are not traded on a stock exchange and that have some amount of liquidity, usually every quarter. So sometimes we'll talk about those types of offerings, but the simple answer is absolutely you can invest straight money, new money, however you call it, into a DST. You don't have to be doing a 1031.
All right. Rosalinda. She has a single family home in Las Vegas. She wants to sell it in exchange for a house in Tennessee. After the new house is acquired, can her son live in the Tennessee house?
That's a great question. In Tennessee, I wonder if you're moving, Rosalinda, to Nashville is a very hot market in the country, very diverse employment, as well as obviously the music industry. A lot of folks are moving there, so that's a really good choice. What the IRS would say is it's a related party transaction as a tenant, not as a buyer. And what the IRS has said is you may absolutely rent your real estate to a related party. The only thing is you have to charge 85% of market rates. That's a specific requirement that they've put out there. Meaning, if rents are going for $1,000 a month, you have to charge at least $850. Otherwise, though, there's no problem having a relative or a friend as a tenant.
All right, here we're getting into the money questions here
Okay.
from Lynn. For a $2 million DST, what are the fees for H&S and what are the fees for the sponsor company?
My favorite question. It really is. The answer is they vary slightly, but I always posited if you looked at a piece of real estate that you were buying on your own, probably about 6% of the price is going to go to the commission to the agents and the title and escrow and maybe some due diligence work that's done, inspections. I think we could all agree that's reasonable. So by way of example, maybe about 6% of $1 million property, $60,000, is going to fees and expenses. In a DST structure, everything is paid through the sponsor, very similar to a typical real estate transaction. And the total amount is more closer to 8 or 9%, sometimes a little bit lower than that. So there's a point or two more in expense in a DST. And I mention that because I misspoke, excuse me. If you have cash investment of $500,000 on $1 million property, the cash investment is really $500,000, the rest is the loan. Well, that would be 12% if it were $60,000, in which case a DST would be 13, 14%. So in other words, whether you look at it from the equity, the cash portion, or just the total value, you're looking at a couple, 3 more points beyond perhaps what you would pay for normal real estate. And that's paid to the broker-dealers for all the due diligence that's done, the inspectors, the lawyers. And yes, we receive a commission that's really usually only about 3%, 2.5% of your investment, very similar to a real estate agent. So I'm comfortable. Every deal you can look at the exact number, but as a generalization, it's a few points more expensive than a traditional real estate purchase. That being said, there's a tremendous amount of value having the property found, underwritten, arranged financing, managed, all on your behalf. So it's well worth the additional cost.
Great. On YouTube, Patrice has a very common question. What is the difference between DST and a REIT?
And a REIT, yeah. Yeah, it is very common, and it is confusing, Patrice. A REIT is a real estate investment trust, as you may know, REIT. It's essentially it's a company that issues stock, and that company's sole purpose is to buy real estate. The IRS says that if you pass through 90% of the taxable expenses, the distributable income, the appreciation, 90% to the shareholders of the REIT, you qualify as a REIT. And the reason for that is it's not double taxed like a traditional stock in a company where they're taxed at the corporate level, then they pay distributions or you get capital gain, and then you pay tax. That's the double taxation you often hear about. A REIT is able to eliminate that by passing through so much to the individual investors, and typically they own hundreds if not thousands of properties, very big companies. It does not qualify for 1031 exchange, first and foremost. It's considered a real personal property interest as opposed to a real property interest, which would be deeded real estate or a DST. Also in a DST, it's typically a one single asset, although sometimes a small portfolio is formed for a single DST. So it's a very different animal. There is a structure, and it's becoming more popular, especially with the uncertainty about 1031, where if a REIT purchases your property, that is not a 1031 exchange, but a 721 exchange. And what that means is the REIT purchases your property, could be your rental home, or it could be a DST. And instead of giving you cash for that purchase, they give you shares in their REIT. That's called an UPREIT. You can do one exchange into an UPREIT, take shares in the REIT. The catch is, when you sell those shares, you're going to be taxed, fully taxed. There's no more tax deferral available to you. But they are really vastly different animals. I would say that a REIT is more like a fund of real estate. Again, it could be thousands of properties. A DST is just another piece of real estate, another property, just like you could be buying on your own, only much larger.
Great. All right. Next question. George, please expound on liability issues having DST ownership.
Yeah, good question. Like George, a LLC, you have a limited liability when you own a share of an entity. So, for example, the property could have liability, the DST could have liability. First of all, if there is a loan on it, then obviously the loan is secured by the property itself, but there's no further recourse. In that example, the bank, worst case scenario, could take the property back and foreclose, but they would not be able to go after individual investors. Same would apply for a slip and fall, as an example, where there could be liability that the property produces. There's insurance to cover these things, just as you would imagine, quite a bit of insurance. But you're really, the biggest liability, the biggest risk is that you could, potentially the property could go away. Extremely rare, to my knowledge, with a co-owned multifamily asset has never happened. I'm speaking back through 2002. But it could happen. That's the worst case scenario.
All right. All right, C.W. Davis, upon reselling a DST, what kind of haircut should one expect?
Now, this is a deceptive one because I'm not telling you this to make it sound good, right? We're advisors. We really want you to know the facts and do what's best for you and your family. The straight answer to your question, CW, is it's going to be a 2 or 3% exit fee or commission, very comparable to a listing commission. I know that for smaller multifamily or commercial, you may pay 4 to 6%. So I don't want you to think it's a huge discount. It is, but that's only because of the nature of the property. In other words, $50 million properties, when they sell, very rarely do you even see 3% selling commission. So the answer to your question is there would be no further expense than selling any other piece of real estate, although the actual fee could be a lot lower just simply because of the nature of listing fees. The sponsor, the way they make their money on the purchase, when they first buy the property, they usually mark it up that same 2 or 3%. That's their reward. That's their profit center. Operating the property when they sell off interest to investors, that's to keep the lights on, to do an effective job of managing. It's not their main profit function. Their profit comes from buying good real estate, marking it up a little when they sell it to you, and then when the property sells on the back end, 6 or 8 years down the line, they essentially have the listing tied up. So they call it a disposition fee, and again, it ranges from 1 to 3%. So you're really not paying any more than you would otherwise. There could be other expenses associating with selling the property, loan payoff, early payoff fee, things like that, but nothing beyond the norm for any other real estate. And as a percentage, it's actually a little lower because of the nature of it.
All right, YouTube, we have E. Brody. How do you eventually get out of a prior 1031 exchange if you want to cash out?
Brody, I'm not sure I understand your question. How do you get out of a prior 1031 exchange if you want? I think I understand. I suspect, Brody, you're saying, again, if you exchange typical 1031 but into a DST and you want to exit and sell your interest before the whole property sells, what happens? And the answer is you have an option when you receive cash for your interest in that DST to do another 1031 exchange. You can have the funds sent to an accommodator, and you could then go buy another piece of real estate. You could buy another DST, or of course you could just take the money and cash out. So I think that's where you're going, is you want to confirm that you're able to continue the chain of exchanges. And the answer is you absolutely can if you sell a DST interest early. We call that an early exit, or if you wait the duration. Either way, when you receive compensation, when you're paid for your interest in either the real estate or the DST, you can do an exchange in all the same 45-day nomination period, 180 close period rules apply.
All right, on YouTube, we have Robert. Over the last year, the pandemic, have you seen DSTs significantly reduce their distribution to investors due to the higher tenant delinquency rates?
Okay, Robert. Just to be clear, I don't know you. You're not a plant. It's a great question. Interestingly, the answer is I haven't for the high-end multifamily and the self-storage for a variety of reasons. But the long and the short of it is, even though there's been a tremendous impact on the economy and the ability of tenants to get away with not paying rent and not be evicted, on the luxury market, and I think I rattled these numbers off along with a lot of other numbers today, normal collection rates, the middle of the subsequent month, these properties usually have 98, 99, occasionally 100%. There's usually always a straggler when you manage 300 or 400 units. That's the normal collection rate. I've seen some decrease down to 96, 97. The only really serious impact, even on the luxury market, was in Orlando and in Las Vegas, for obvious reasons that these are entertainment capitals, and a lot of people were impacted. But that being said, it's been a fairly minor hit, if you will, or a very minor impact, and I'm very pleased that our clients haven't received a single phone call because it just has held up really well. On the B and C class apartments, I don't sell them, but I have read statistics that they've been collecting now, while they're normally perhaps in the mid-90s or lower, 70%. They've lost quite a bit of collections, and that lack of collection of rent, that 30%, means that those investors in those types of properties are not receiving anything. If it's a retail establishment, we all know retail has struggled. Some companies have been able, even if they were closed, like some restaurant chains, to continue to pay rent. Some of them, I heard Cheesecake Factory as an example that's familiar to everyone, told all their landlords once the shutdown began, they're not going to be paying rent. And they've worked it out with those landlords, and now they're coming back. You all probably in Southern California know Soup Plantation, a great regional chain. They closed and went out of business immediately, anticipating the duration of the pandemic. And of course, they are not honoring those leases. They're no longer in business. So the answer to your question is you want to be in whatever is safest come what may. Natural disaster, pandemic, which I can add to the list, and most importantly and typically recession. What's the most recession resistant? And that would be apartments and self-storage.
All right, last question from George. Management fees?
Management fees. Kind of like the same answer as the disposition fee or the listing commission, the percentage you may pay 8 or 10 or what have you percent of the gross rent collections to your property manager plus other fees, right? I think everybody would agree that's sort of typical. Well, in this space, we're down to much lower as a percent. And once again, we're around 3% management fees. That's just covering the expense of management, the staff in the leasing office, the reputation management online. There's software to maintain to keep up with market rates. All that work is covered. It's built into the costs of running a DST property, and that 4 or 5% net cash on cash I mentioned, let me stress, is after all those bills are paid. But I go back to the percentage. I don't want it to be deceiving in the sense that I'm saying, hey, this is better than real estate. It's just that a property manager needs to collect a much larger percentage of your rent when they're managing few units. When it's hundreds of units, those economies of scale enable a much lower rate. And all this is built into the offering memorandum and disclosed, by the way, very clearly and transparently, so you know what the expenses are going in. I will add that I know a lot of investors, from my experience, are concerned that the property manager is raising the rates, right? They're using Cousin Murray to do the plumbing, who marks everything up 200%. Believe me, I've heard the horror stories. It's a valid concern. It happens. In a DST, there's full disclosure of everything. So you'll see a copy of every invoice if you want to. The investor has a right to that in the DST. And again, they charge what are called market rates, prevailing rates. And they just happen to be a lower percentage for management and for commission. But bottom line, the goal of a good sponsor is to maximize the revenue, the net operating income, and keep up with market rates, keep the property turning, as they call, which is to say occupied, but with new tenants coming in, and sell it 6 or 8 years down the line, perhaps, hopefully achieving maybe even an average of double digit or 10% plus annualized return after that 6 or 8 years, when you take into account the appreciation and the cash flow. Every property is different. Some are wildly better. Some have done worse. But that's a good kind of average.
Great. Well, thank you, everyone, for hanging in with us all this way. And we're glad that we were able to answer your questions. And anyway, just keep subscribing. If you don't, I didn't mention this, but we have a free e-newsletter. You can sign up for that if you go to aoausa.com. You can sign up there at the bottom. If you scroll all the way down, there's a little place where you can put in your information, and then we'll get you the information that's applicable to you. So if you're in Southern California or Northern California, wherever, we're going to get you the information that you need. We want to keep you in the know. That's what our goal is, to give you an idea that'll help you make and or keep more money than ever before, and to make the process of providing housing easier and more enjoyable. So that's what we're here for. I think that this was a good live stream for you to give you an idea on how to do that. And so yeah, go ahead. If you haven't joined AOA, go ahead and go on to our website or call in, and you can set up a membership. And anyway, thank you so much again for joining. Don't forget, next week we have, is it next week? Yeah, about how to prepare for small claims court, to how to recover the money that is entitled to you. And so that should be a good one. And then also master the tenant move-in process, and that one's done by pros. So again, you'll want to tune in for that. And thanks again, everyone. And thanks again, Adam and H&S Wealth. And we'll see you next time.